Today we shall discuss about trade finance. In this chapter we will discuss about the following topics, namely basics of trade and trade finance, objectives of trade, risk involved in trade, role of a bank in trade, how a bank mitigates the risk, role of ICC, that is International Chamber of Commerce, in trade finance, fundamentals of letter of credit and its various types, export finance, factoring and forfaiting, Incoterms, remittance process, import finance, SWIFT, forward contract, and bank guarantees. Now we will discuss in detail one by one what is basically a trade and a trade finance. Trade is nothing but exchange of goods or services for a consideration between two or more parties. However, anything given free is not a trade, but it's a gift. Earliest form of trade was barter system, where people used to assemble at a common place, usually a market, and exchange goods when there was no currency system. For example, an agriculturist will sell his produce for exchange of some other goods of an equivalent value, which he required for his daily life. In this case, no money was exchanged between seller and purchaser for the transaction. Cattle were exchanged for purchase of food articles like rice, wheat, and other pulses. Likewise, a vegetable producer may sell his vegetables for purchasing other materials like pulses or oil or any other goods for daily consumption. However, after the discovery of currency, people started fixing a value for their own products and started collecting currency in place of other items. Of course, before the arrival of currency, coins were used made of silver or gold. Subsequently, after introduction of paper currency by China, it has spread across the board of all countries. Trade can take in any form. It can be goods or services. Commodities also can be in any form. For example, it may be raw material or finished products or machinery for industrial use, or anything needed for consumption, or any item of luxury or fashion. It can also take the shape of metals like gold, silver, platinum, copper or zinc, or any other goods used for consumption. We can see the list is endless. Storage of huge quantities of goods requires space, labor and money. Naturally, there are chances of theft, pilferage, loss or deterioration of goods over a period of time. To mitigate such risks, goods have to be insured with an insurance company and also get protected from all such dangers of theft, pilferage, deterioration, etc. This will all cost additional expenses to the buyers in keeping the goods in good condition and for saleable purpose. In view of the above reasons, and over a period of time, different stock exchanges come up across the world, and the goods have, instead of the movement of goods, people used to trade the goods or commodities over the stock exchanges. Nowadays, most commodities can be traded at commodity exchange at important cities of a country, while shares, debentures, bonds and mutual fund products also can be traded through stock exchanges located at different cities of all the countries. For example, in India we have major stock exchange like Bombay, Calcutta, Chennai, Indore and other places, Ahmedabad, Cochin. Even in tier 1, tier 2 cities also stock exchanges have come up, and the trades become hassle-free. Trades have become easy now. Now, instead of purchasing physical gold, people can also purchase a certain number of units of gold through exchange traded funds through stock exchanges. Only thing is that the customers have to pay certain fees to the depository participant for maintaining the accounts and for doing the transactions during the particular business hours as prescribed by them. Since the value of these units varies from time to time and are quoted at main stock exchanges of the country, this can be traded at the convenience of the demat account holder, of course within the stipulated time of business. The physical movement of goods does not exist when trade is done through exchanges. These exchanges do perform the activities of a trade required by different customers located at different cities. They can do now by sitting at their home using the internet as well as by phone also. They can either purchase or sell the shares, debentures, or whatever may be, mutual fund products, whatever may be, by informing their DPs through which they have opened the account. Whenever the transaction takes place, individual specific account is either credited or debited with the equivalent quantity, which will help them to trade further at his ease as and when the price movement takes place, or at the requirement of the customer. When he needs money, he can sell it off. He does not have to bother about movement of goods whenever he opens a demat account for trading. Thus, we can see that trade has evolved over a period of time to the present level.